MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Tim, the big picture, are we again near the top of the stock markets?
Well, the potential is certainly at hand. And what I would like to do, it's been a while since we've done this, and I don't even remember. Maybe it's been years since we've done this, but I would like to go back and paint some broad strokes of where we are and kind of how we got there, and try to help people envision the bubble that we're really in. And to do that, let's digress back to the 1980s and 90s. And, I was working, a young CPA working in the telecommunications industry. And, I remember the dot-com bubble and being involved in the telecom and that sort of thing. And it was, it was a real economy. It was a real, it was real. It was, a real boom. And the stock market, as we all know, the Dow Jones Industrial Average peaked in January of 2000. The S&P peaked in March of 2000. And the interesting thing, talking about the legitimacy, if you will, of the economy back then, and I know this sounds like maybe old data that doesn't apply. It certainly does, and it shows the extremity of the situation that we're really in today. But if you look at that top from a Dow theory perspective, if you look at the stock market top from a Dow theory perspective, there was a Dow theory primary bearish trend change had occurred. Richard Russell made the call. But leading into that top, we saw economic indications of, a real economic slowdown. You look at the velocity of money, and it peaked in 97, and you had a divergent top in 2000. And so that was a real warning that, things had changed. We had reached some sort of a economic business cycle, whatever you want to call it, plateau. And not only did the stock market confirm, but the underlying, some of the underlying economic indicators in my mind that really matter. I mean, the velocity of money, how fast money is turning over. I mean, it showed that. And this data is not something that's made up. It's not subjective. I mean, it's hard data that came from the St. Louis Fed, and you can see it. In addition, at that top in 2000, we saw the labor force participation rate. And, it peaked in March of 2000. So everything, converged in that early 2000 time frame with a real top, a real slowdown. And that's the point. From there, the market obviously declined into the 2002 4-year cycle low. I had made the call and said that we would decline below the 98 low. We did. I mean, exactly according to statistics. And then that's where the funny business began. And then, we rallied into a very extended, at that time, the most extended 4-year cycle advance in history into the 2007 top. And, that was by and large liquidity driven. I said that it was a bear market rally, and I'll explain that in a minute. It did take the market to a new high, but the interesting thing is that while we did get a little bit of an upturn in the labor force data and the velocity of money, it was minuscule. The upturn, we finally had a bottom in the velocity of money in 03, a bottom in the labor force data in 04. They both peaked in 06, and then formed a little bit of a divergent top with that extended 4-year cycle. And then we all know what happened following 2007. Commodities, all of it collapsed together into the 09 low. And then that's when, things got even more insane. More of the same policies that created the worst financial crisis since the Great Depression were employed, I guess you would say, and then created an even greater bubble into the 2015 tops, and then we had that very minor decline into the 2016 4-year cycle low. And even President Trump, when he was campaigning, he talked about the bubble way back then. And there's video on that, and he was right. I mean, it truly was a bubble. But what's interesting now is that since he's gone into office and is making America great again, and you look at this velocity of money, it has some minor little tick up, but now it's softening. It's at the lowest level since 1959, or that's where the data begins on the St. Louis Fed's database, and it's still at the lowest level since the inception of that data. You look back at the labor force data, there was a little bit of a tick up coming out of the September 15 low, which coincided with the 4-year cycle low in equities. And it hadn't been anything. I mean, it's just a minor little hiccup. And then, it's turning back down. And so the point here is that, I don't know where or how much of this data is manipulated, and say, well, jobs are expanding and point to that piece of data or that piece of data and try to paint the picture that the economy is better. Bottom line is, if the economy is better, why is money not turning over? Bottom line is, if the economy is better, why are people not work? Why is the job participation rate? Why are there fewer people percentage-wise working today in this country than there were in the I can't see the chart now, but in the late 70s? So the point is that we have been in a bubble environment since 2000. There has been a liquidity-driven policy to save the market, and like I said, the same practices that created the worst financial crisis since the Great Depression in 2009 were put on steroids to create the bubble that we're in now. And this data has not changed. If you also look at the volume characteristics of the market itself, they have continued to decline, their bear market characteristics, but we continue to levitate in this bubble. And now, you ask where we were, and I know you want to take a break, but now, here we sit at a juncture. And I can pick up there if you want to after the break.
We'll have more with Tim Cyclesman Wood right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome back. We're speaking with Tim Cyclesman Wood. So, Tim, continuing the story about the same practices that got us into big-time trouble are still being used, and what's more, in the U.S., they've reduced banking regulations for the small and mid-sized banks, but they weren't the problem makers, were they? They were the big boys, weren't they?
Yes, and let me talk about this bear market rally before I forget. You know, I deemed it the advance out of the 2002 low a bear market rally, and I'm not trying to give double speak here, so and justify my position. I'm telling you what the data says. I can see the market went to a new high. That's indisputable. I am not denying that at all. That 4-year cycle is the most extended 4-year cycle in stock market history. I'm not denying that at all. The fact that it was the most extended proves the extremity of the advance. So the data speaks for itself. What I'm saying is it wasn't organic like any other, secular bull market in history. That's what I'm saying about it. I'm not denying that it went to a new high. I'm not denying that it lasted longer than we thought. But as I said then, once my DNA markers were in place, that it would collapse and that it was not going to end well, and yada yada, and that proved to be correct. And now here we are in take two. Well, with this take two, I want to point back at, I've talked about how crude oil was pushing into a 4-year cycle top, or a 3-year cycle top, commodities into a 3-year cycle top. We've talked about how gold, it has proven, it made an early, kind of an odd 9-year cycle low, but yet that everything was in countertrend advances. Well, looking back, crude oil peaked in 2008. If you look at the CRB, it peaked in 2008. Equities peaked in October of 2007. So everything pushed into highs together. Everything collapsed together. And then everything rallied together. And the exception is that if you look at, for example, crude oil, it pushed into a secondary high. Kind of like, I hate analogies because they're kind of corny, but you throw a rubber ball in the air, and then when it comes down, the first bounce is the highest. And then it bounces again and it's a little lower, and it bounces again and it's a little lower. Well, with commodities, the bounce into the 2011 high was lower than the 2008 high, and you see the same sort of thing with the CRB complex. You see the same sort of thing with gold. And then looking at crude oil specifically in the CRB, we moved lower. And then we bounced again. And this latest bounce has been a 3-year cycle, a bounce into a 3-year cycle top. And when you look at it, it feels like, looking at the CRB, that it's bounced forever. I'm looking at the advances. It's up 23 points. It bounced to the 23.6% mark from the 3-year cycle low in late 15, early 16. And now it's sitting at a 3-year cycle top. If you look at crude oil, it has advanced from, if I'm seeing this right, it has advanced it's advanced to the 38.2% mark from the high in 2008 to the low in 2015, and what I think is a counter-trend bounce. So at the same time, these other asset classes have been in counter-trend bounces. The liquidity infusion in the equity markets has driven them to artificial new highs. So on the one hand, were they bear market rally advances? Bet your ass they were. Did they go to a new high? Yes, they did. Why? And it's not an excuse, but obviously we all know, because of the liquidity infusion into the market that has created the bubble that it's created. So my stance has not changed. This is truly the biggest bubble, I think, in the U.S. stock market history, biggest bubble I can point to, and we saw technical readings to that effect back in January. We saw some of the most overbought readings by some technical measures since the inception of my database. It goes back to 1800. And then, we've seen, and I've talked about how the Hussman models have shown the valuations at the most extreme ever. And at the same time, because this has gone on so long, and I've talked about this before, it has kind of lulled people to sleep. And, if you see an extremity long enough, it becomes the norm by definition. So it feels like a norm. It feels like it's sustainable. Nobody realizes the bubble, the situation that we're in, but we're in it. And then you ask, so where are we? Well, technicals are kind of like equated. Again, I hate analogies because they tend to be corny, but it's kind of like, driving down a road. You can't turn and get off the road until you get to an intersection. I mean, I guess you can go through the ditch, but you know what I'm saying. But you get to the intersection, it's an opportunity to turn. And you have these technical junctures. And we're at a technical juncture again now. We've been at this technical juncture, really at a longer-term technical juncture since fall. We talked about the dollar. You asked me, I think it was our first January show, what was one of the surprises going to be for this year, or major events or turns or something like that, and I said the dollar. And I think that this juncture is by and large centered around the dollar. We've seen that major bottom in the dollar that I've fully anticipated. It's finally in place. There's going to be some short to intermediate term weakness here because it's been on fire, and there's some cycle lows coming up due. So that doesn't bother me. The longer term bottom is in place. I said at the same time, part of this juncture that we've been in, this bigger technical turn window, if you will, was commodities peaking. They're pressing into this counter trend bounce, and equities. They've also been pressing into this counter trend bounce. The first shot was fired with the equities back in February, and now we've seen this levitation, this counter trend bounce, and some stuff has moved to new highs, some haven't. That has given us some non-confirmations, and it's decision time. I mean the markets are again at that technical juncture. I don't know, nor does anyone else, precisely how this is going to unfold. But I do know we're in the process of it unfolding. I know we're in that juncture. And there are some technical hurdles that are either, it's kind of like a matrix. Either it's going to be surpassed or it's not. Okay, if it does, what does it mean? Okay, if it doesn't, what does it mean? So we're at that juncture where equities, it's decision time. Does the can get kicked down the road a little bit and this evolve a little longer, or do we see the turn? So, that said, I know it's kind of long-winded, but we've been looking for the top in oil, and we've seen the first indications that we may well be there. Gold, very disappointing. It has proven that we had the 9-year cycle low back in 15. That's not a good thing because look at the performance. I mean, come on. It peaked 7 months after that cycle, and we've been sideways since. That's not good. And I think ultimately what we're setting up for is for pretty much all asset classes to collapse together, just like they did in 2007, 8, and 9.
We'll have more with Tim Cyclesman Wood right after the break.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, if you believe all asset classes will come down at the same time, that means real estate, the stock market, gold, oil, everything tumbles at once. Is there any safe haven?
Well, as ironic as it sounds, cash, and the dollar. I was hoping that we would see gold play out where gold was going to be at a 9-year low, and that gold would be that safe haven. But that just didn't shape up. And so I think it's like an old man told me one time. He said, there's not two positions in the market, and he meant long or short. He said there's three: long, short, and on the sidelines. And, the sidelines is maybe not sexy, but I think that's going to be the place to be. I mean, obviously when this bubble comes unwound, unless someone has the courage to try to take a shot at shorting it, but it's drug out so long, and, it'll try to set up and then it won't, and it'll try to set up and it won't. And that's part of what has driven the bubble as well, is the short covering. So, that's going to be very difficult to do, but I think if someone could get that right, that would be very lucrative, obviously. And as far as timing it, you look at the technical data that you have at any snapshot in time, and it has a meaning. It tells you something. What is is there a cycle due? Is it a left translated cycle? Is it this? Is it that? And all that data paints a picture and tells you something. And then, of course, it's a fluid situation, and every few days, or maybe every week. I mean, sometimes it doesn't change day to day, but the data does change. And so then it paints a new picture and tells you something else. So that said, all you can do is read the data that you have, and I recognize that it is, like I said, you could hold a gun to my head. I'm not going to change my opinion. I mean, I see it. It's there. It's biggest bubble ever, and it's not going to end well. But we have to get a setup in place to cap it. And again, we're at one of those junctures. So let's see what happens.
Tim, when you talked about the velocity of money, I'm wondering, when we hear about companies and certain individuals having huge stores of cash that they're just sitting on, when they have investment funds of $75 billion just sitting there, is it because they've taken so much money out of circulation and they're just sitting on it and it's not going anywhere, that there isn't a lot of money in circulation to do things?
No, I don't think there's any. I don't know the answer to that. I mean, I don't think there's any shortage of money in circulation. I just think it's not changing hands because of the underlying economy. I mean, to me, that's what that data is telling me. I mean, why was the velocity of money expanding during the true secular bull market period? Why was it expanding when the job participation rate was expanding? I mean, it's pretty ironic that it's contracted. Everything is contracting now. So, I don't know really the answer to the question. I just know what the chart is showing me.
Tim, thank you so much for chatting with us.
Thank you. My
guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. If you have any questions for the show or our guests like Tim, you can send them to info@howstreet.com. And don't forget, every weekend we have our master show, This Week in Money, where we talk to some of the top economic minds on the planet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.